You got another raise this year, maybe 5% or 7% if you're a great negotiator.
Your salary is at an all-time high.
You should be saving more, building wealth faster, and finally getting ahead. But then you look at your savings account and see almost the same figure as 12 months ago.
Maybe even less.
You're earning more than ever, yet somehow, you have less to show for it than when you were making $20,000 less.
This isn't bad luck, nor is it because you're irresponsible with your money.
The truth is, the math of wealth building in 2026 is completely broken. Most people only realize this after years of spending their raises before they even notice them. I'm Wyatt, and I watch people get raise after raise only to see their net worth stall or decline. If you're earning more than you were 2 years ago but your savings haven't grown proportionally, or if you want to understand why your raises keep disappearing, follow the channel and hit the like button if this helps you out.
Let's talk about what should happen when you get a raise.
You were living on $60,000 and got bumped to $65,000. That extra $5,000 a year should go straight into savings or investments.
Your expenses don't magically increase just because your paycheck gets bigger, right? In theory, that raise should translate directly into wealth creation. It doesn't. It's not even close.
For most people, raises completely vanish within 3 to 6 months due to a combination of factors no one warns you about. Let me show you exactly where your raise goes and why your savings aren't growing despite earning more.
Meet Daniel.
2 years ago, he was making $62,000 a year. He just received his second annual raise and is now earning $70,000. That's an $8,000 increase in 2 years. With that much more per year, he should have added at least $16,000 to his savings. Instead, Daniel's savings account has grown by exactly $2,000. He has no idea where the other $14,000 went.
Here is what actually happened to Daniel's raises, the same thing that's happening to you. First, taxes take a huge chunk before the money even hits your bank account.
When Daniel went from $62,000 to $65,000, that $3,000 raise shrunk to about $2,100 after federal taxes, state taxes, Social Security, and Medicare. $900 was gone to taxes before he even saw it. When he went from $65,000 to $70,000, that $5,000 raise shrunk to about $3,400 after taxes. Another $1,600 to taxes. Out of an $8,000 total raise, he only put about $5,500 in his pocket. He lost $2,500 to taxes before he even had a chance to think about it.
Most people don't factor this in.
They get excited about a $5,000 raise and mentally budget for $5,000 more.
But taxes don't work that way.
You don't get the full raise, you get what's left after about 30% to 35% is deducted, depending on where you live and your tax bracket. That's the first place your raise disappears. But it gets worse. In 2025 and 2026, inflation hovered around 4% to 6% annually. Even without changing his lifestyle, Daniel's cost of living increased significantly over these 2 years. When his lease renewed, rent went up by 6%. That's $180 more a month, or $2,160 a year.
Car insurance went up 15% because rates are currently brutal, that's $40 more a month, or $480 a year.
Groceries are about 20% more expensive because food inflation has been ruthless. If he was spending $400 a month, it's now $480, an extra $960 a year. Electricity bills went up, phone bills went up, streaming services hiked their prices, and gym fees increased.
Every recurring expense in his life became more expensive.
Collectively, these increases ate about $4,000 of his post-tax raise over 2 years. He isn't spending more on entertainment or upgrading his lifestyle, he is just paying more for the same things he bought 2 years ago.
Let's pause and add this up. Daniel got an $8,000 raise.
Taxes took $2,500, leaving $5,500. Inflation on existing expenses took $4,000, leaving $1,500. He still should have had a $1,500 increase in real purchasing power.
Why isn't it in his savings account? This is where it gets insidious. Lifestyle creep happened so gradually that Daniel didn't even notice.
When he got his first raise from $62,000 to $65,000, he felt he could finally live a little better. He moved from a studio to a one-bedroom apartment because he was pushing 30 and living in a studio felt stifling. The one-bedroom was $300 more per month than his studio, that's $3,600 a year. He justified it because he got a raise and felt he deserved to live in a decent area. He also ditched his 15-year-old car that kept breaking down. He bought a 3-year-old certified pre-owned car, a responsible choice compared to a new one, but it came with a $250 monthly payment.
An extra $3,000 a year he wasn't paying before.
He justified it by saying his old car was unreliable and that, with his raise, he could afford the car payment. Now, just those two decisions, the apartment upgrade and the car payment, consumed his $9,300 raise. But remember, his post-tax raise over 2 years was only $5,500, and inflation already ate $4,000 of that. So these lifestyle upgrades weren't funded by his raise, they were funded by the money he should have been saving. This is why his savings barely grew despite getting an $8,000 raise. But Daniel still doesn't understand where his money went because those decisions seemed reasonable at the time. He wasn't being reckless, he didn't buy a luxury car or move into a penthouse. He just moved into a one-bedroom apartment and bought a reliable used car.
These are normal adult decisions that millions of people make.
The problem is, in 2026, normal adult decisions cost so much that they consume the raises that would have built significant wealth.
This is the core problem with savings growth in 2026. The gap between getting a raise and actually finding more money to save has become massive. Your raise is first hit by taxes, reducing it by 30% to 35%. Then, inflation takes another slice by making all your existing expenses more expensive.
Then, lifestyle creep consumes the rest because you feel your increased income should translate to an improved quality of life. By the time these three forces are done with your raise, there's nothing left to save.
Let me show you with real math.
You earn $70,000 and get a 5% raise to $73,500.
That's a $3,500 raise. After taxes, you have about $2,400 in your pocket. A 5% inflation on current expenses, let's say $50,000 a year, costs you $2,500. Without making a single lifestyle change, you're already $100 in the hole. Your raise didn't even keep up with inflation on your current standard of living.
A 5% raise is only enough to maintain your current standard, anything beyond that is real progress. This is why people feel like they're falling behind even when they get raises, because they actually are. When inflation is 5% and you get a 3% raise, your purchasing power has decreased by 2% even though your salary went up. You're earning more but are poorer than last year. The number on the paycheck is higher, but what that number can actually buy has shrunk. Now, let's talk about bracket creep, because this is destroying people's ability to save in 2026. When you get a raise, you don't just pay more taxes because you're earning more total dollars. You might also jump into a higher tax bracket where every additional dollar is taxed at a higher rate. Daniel, making $70,000, is in the 22% federal tax bracket. If he gets a big raise to $85,000, a portion of his new income is taxed at 24%. He's earning more, but he gets to keep a smaller percentage of every extra dollar. This gets even worse in high-tax states. If you live in California, New York, or New Jersey, you pay state income tax on top of federal tax. In California, a $70,000 salary has an effective tax rate of about 28% to 30%. A $90,000 salary might be 32% to 34%. Your raise was hit with a higher marginal tax rate than your base salary, meaning you keep even less than you expected. No one explains this when you get a promotion or change jobs. They tell you your new salary, and you calculate what your monthly income should be based on your current tax rate. Then your first paycheck comes, and it's less than you expected because you didn't account for bracket creep. You plan to save $400 more a month from your raise, but your actual take-home only increased by $270. Where does that $130 monthly loss go? It goes to taxes and never gets a chance to build wealth.
Here's another factor ruining savings growth in 2026:
the erosion of employer benefits. 10 years ago, a job paying $60,000 might have included full health insurance coverage, matching 401k contributions, and maybe a pension. Now, a job paying $75,000 offers a health plan with a $5,000 deductible, a 401k match that only kicks in if you contribute 6%, and absolutely no pension. Your salary went up, but when you account for worsening benefits, your total compensation might have actually decreased. Daniel's health insurance at his new, higher-paying job requires a $200 monthly contribution. His old job covered it entirely. That's $2,400 a year from his raise going toward health insurance that used to be free. Dental and vision insurance are now separate, that's another $60 a month, or $720 a year. The company changed their 401k match from dollar for dollar up to 4% to 50 cents on the dollar up to 6%. He now has to contribute 6% just to get the match he used to get with a 4% contribution. That's another $90 a month, over $1,000 a year. These benefit changes are invisible if you're not paying attention. But they eat thousands of dollars a year from your raise. You think you got a 10% raise, but when you account for worse health insurance, worse retirement benefits, and higher out-of-pocket costs for things your employer used to cover, your real compensation increase might only be 4% or 5%.
And that's before taxes and inflation.
Let's talk about subscription creep, because this is silently ruining everyone's savings without them noticing. When Daniel was making $62,000, he had Netflix and Spotify. It seemed reasonable, $20 a month total. Over the next 2 years, as his salary increased, he added Disney Plus because everyone was talking about their shows, then HBO Max for specific series, then YouTube Premium because ads were annoying, then a news subscription to stay informed, then a meditation app for the stress about money, then a meal kit service because he was too busy to shop. Every decision seemed small. $10 here, $15 there. But Daniel is now spending $135 a month, $1,620 a year, on subscriptions. When he was making $62,000, he was spending $240 a year. That's a $1,380 increase just in subscription spending. He didn't make a conscious decision to spend $1,380 more on subscriptions. It just accumulated gradually as services launched and his income rose, and he felt he could afford each addition. This is lifestyle creep in its purest form. Every subscription looked affordable on its own. $10 a month when making $70,000 is nothing. But $10 here, $15 there, $20 elsewhere adds up to over $100 a month. That's money lost from your savings potential. Multiply this across every category of your spending: food delivery services, upgraded phone plans, convenience shopping, and you'll see hundreds of dollars a month being consumed by lifestyle creep without you even noticing. What makes this especially devastating is that these subscriptions and lifestyle upgrades set a new baseline for your spending. Daniel was spending $4,000 a month when making $62,000, a raise to $65,000 should have meant $300 more a month for savings. But his spending also rose to $4,300 a month through the apartment upgrade, car payments, more subscriptions, and general lifestyle inflation. Now, when he gets another raise to $70,000, he's starting from that $4,300 baseline instead of the original $4,000. His expenses are permanently locked upward. This is why people who earn $100,000 feel as poor as when they earn $60,000. With every income increase, their expenses increased by an equal or greater amount. They never caught up to their savings goals because they immediately funneled the money into lifestyle improvements. And now they are stuck at that high spending level they cannot go back from without feeling deprived. If you want your savings to grow, let me show you what you should actually do when you get a raise. You're making $70,000 and get a $5,000 raise to $75,000. That $5,000 becomes about $3,400 after taxes. Immediately, before that first higher paycheck hits your account, you need to set up an automatic transfer that sends that entire $3,400 annual increase directly into savings or investments.
That's a $283 monthly transfer that moves automatically before you spend it. Your checking account should never see that raise. If the money enters your checking account, you'll spend it.
You'll upgrade something, or increase your discretionary spending, or subscribe to something new, or eat out more often.
The money evaporates and you wonder where it went.
But if it's automatically transferred to savings, you adjust to living on your previous income because there are no other options, and your savings actually grow. This is what people who build wealth do differently. They don't let their raises hit their checking accounts and then hope they'll be disciplined enough to save the rest. As soon as the raise takes effect, they automate the increase in savings. Their lifestyle stays frozen at their previous income level, while every raise is captured for wealth building. This feels restrictive and unpleasant. It feels like you aren't enjoying the fruits of your success. But this is the only way for raises to turn into actual growing savings. Yet, even this strategy has problems in 2026 due to inflation. If you're saving your entire raise but inflation is eating your existing savings, you aren't truly getting ahead. Your savings number might go up, but your purchasing power stays flat or even declines. You saved $3,400 more from your raise this year. But if your existing $50,000 in savings lost 5% of its purchasing power to inflation, that's a $2,500 loss in value. Even though you saved $3,400 from your raise, your real savings increase was only $900. This is why people feel like they're running on a financial treadmill. They're doing everything right, they're saving their raises, avoiding massive lifestyle inflation, acting responsibly, but inflation is quietly ruining their progress faster than they can build it. Your savings account balance goes from $50,000 to $53,400, and you think you're making progress. But if inflation was 5%, your savings needed to grow to $52,500 just to maintain the same purchasing power. Your real gain was only $900, not $3,400. This is what you actually need to do in 2026 to grow your savings despite raises being consumed by taxes, inflation, and lifestyle creep. First, you need to be aggressive about tax optimization. Maximize your 401k contributions because it reduces your taxable income. If you can contribute $23,000 to your 401k, that's $23,000 of income you aren't paying taxes on right now. You'll pay taxes when you withdraw it in retirement, but you've deferred that burden, and the money compounds tax-free in the meantime. If you have a high-deductible health plan, use a health savings account, HSA. HSA contributions are tax-deductible, grow tax-free, and can be withdrawn tax-free for medical expenses. This is the best tax-advantaged account available, and most people don't use it. Consider a Roth IRA for after-tax contributions that grow tax-free forever. The goal is to minimize the 30% to 35% of your raise going to taxes, ensuring more of it goes toward wealth building. Second, you must track every dollar of lifestyle creep and actively fight against it. When your rent increases, don't just accept it. Can you negotiate? Can you move to a cheaper place? Can you get a roommate? When subscriptions increase their prices, cancel them. When you're tempted to add a new subscription, ask yourself if you'd rather have the subscription or that money invested. Most people would prefer the money invested, but they choose the subscription because it seems like a small amount and they don't think about compound growth. Third, you need to increase your savings rate faster than inflation. If inflation is 5% annually, your savings need to grow by more than 5% to represent real progress. This means it's not enough to just save your raise. You need to save your raise, plus cut existing expenses, plus find extra streams of income. You need multiple engines working at the same time to overcome the headwind of inflation. Fourth, you need to move your money into investments that can actually beat inflation. A high-yield savings account earning 4% is losing purchasing power when inflation is 5% or 6%. Your money needs to be in index funds, real estate, or other assets that have historically grown faster than inflation. Yes, these investments have volatility and risk, but keeping all your money in cash guarantees you get poorer every year even as the number grows. Let me show you what this looks like in practice. Emma earns $68,000. She gets a $4,000 raise to $72,000. After taxes, that's about $2,700 more annually. Instead of letting it hit her checking account, she immediately increases her 401k contribution by $225 a month.
This money goes directly into investments, never touches her checking account, and reduces her taxable income.
Instead of upgrading her apartment, she renews her current lease and keeps her rent the same. She audits her subscriptions and cuts $40 a month from services she rarely uses. She directs that $40 to a Roth IRA. Her total monthly savings increase is $265. In a year, that's $3,180 added to investment accounts that will grow by 8% to 10% instead of eroding at 4% in a savings account. At the end of 1 year, her investments have grown by $3,100 from contributions and another $800 from market returns. Her real wealth, even after accounting for inflation, has increased by $3,900 in real purchasing power. Compare this to Daniel, who got a similar raise but let it hit his checking account, upgraded his lifestyle, and saved almost nothing. Same raise, completely different results.
Emma's net worth is growing. Daniel's is stagnant despite his higher salary.
Here is the uncomfortable truth: your savings aren't growing in 2026 because you're letting the system consume your raises instead of fighting to capture them. Taxes take their share automatically. Inflation erodes your purchasing power automatically.
Lifestyle creep happens automatically when you don't actively resist it. The default path leads to stagnant savings despite increased income.
Building wealth requires fighting all three forces at once. And most people either don't realize they need to fight or lack the discipline to do so. Your raises are real. The money is there, but through a combination of tax policy, inflation, and your own spending decisions, it's redirected before you can build wealth. If you want your savings to actually grow, you have to capture your raises before these forces consume them.
Automate your savings growth. Optimize your taxes. Resist lifestyle inflation. Invest in assets that beat inflation. Do all of this consistently every time you get a raise, and your savings will finally start growing like they should. Or, keep doing exactly what you've been doing. Keep wondering where your raises went and end up with the same amount of savings 5 years from now, even though you're earning $30,000 more. The choice is entirely yours.